Everyone, welcome back to another episode of Getting Your Shit Together, the podcast that helps you take control of your finances one smart decision at a time. I'm your host, Neil, and today I'm going to get into two topics: why you need an emergency fund, and followed by how to deal with the upcoming mortgage renewal shock. One of these topics is about preparing for the unexpected, and the other is about an unfortunate financial storm that we do see coming. Now, I know financial emergency, shock, these are not exactly the words you want to hear on a relaxing drive or while sipping your morning coffee, or for that matter, any day. But here is the deal: if you plan for these things, they do not have to be as scary. So, today we are going to cover two big things. First, how to build an emergency fund, the why, the how, and the common mistakes to avoid. And then we'll talk about mortgage renewals, especially for those of you who locked in super low rates back in the 2020 to 22 era and are now staring down at a much higher monthly payment. So let's get into it. So, all right, let's start with a scenario. Imagine this: you wake up one morning, grab your coffee, and just as you're about to start your day, your car won't start. Unfortunately, you're not working from home, and so you have to go to office. So you get your car towed, and the mechanic gives you that look, and boom, a $2,000 repair bill. Or maybe imagine that your fridge suddenly dies, and you got $300 worth of groceries melting away. Or it's like when you took a vacation, but forgot to check the baggage fees. Surprise, surprise. You're paying $100 just to bring on a carry-on. Or worse, you lose your job unexpectedly. So what do you do? If your answer is, well, I will put on my credit card and figure it out later, you're not alone. But that's exactly why we need emergency funds. This is one of those things people know they should have, but somehow it always ends up on the, well, I will deal with it later list. Right next to exercising, eating more vegetables, and cleaning out that junk drawer that has been overflowing for the last 10 years. But in all seriousness, unexpected expenses happen all the time: car repairs, medical emergencies, job loss, or even an emergency flight to see family. And if you don't have savings set aside, you end up covering for these costs with the credit card or some other high interest loan. That means you are not just dealing with the emergency, you're also dealing with the high interest debt that makes everything way worse. Hence, the need for an emergency fund. So, what is an emergency fund? Well, it is your financial airbag, there to protect you when life hits you with the unexpected. It is not for the vacations, it is not for your regular shopping, it is strictly for emergencies, things you could not have planned for. So, what are the benefits of an emergency fund, you may ask? Well, it is for, well, firstly, peace of mind. Life is stressful enough. Knowing you have money set aside makes financial surprises less of a crisis. Secondly, it's about avoiding unnecessary debt. If you don't have any savings, you're likely turning to credit cards or payday loans or some other form of high interest loan. And so that is never good. Thirdly, more control over your choices. If you happen to lose your job and have savings, you can afford the time to find the right job instead of jumping into something that you don't like or something just to pay the bills. Now that I've hopefully convinced you about the need for having an emergency fund, let's talk about how you should or how much you should have in that. The answer is it depends. Financial experts often say 3 to 6 months worth of essential expenses. But let's break it down a little more. The general rule of thumb is 3 to 6 months of essential expenses, but that's just a starting point. Here's how we figure it out. Firstly, you should list your all your essential expenses. Now, that could be rent or mortgage payments if you own a home, groceries, utilities, insurance, transportation, and minimum, at least a minimum payment on all the debts, the non-mortgage debts. Secondly, if you have a stable job with a steady paycheck, you can probably aim for about 3 months of such expenses. If you are self-employed, work on commission, or have, let's say, a variable income, or maybe even work in an industry prone to layoffs, then you should aim higher. I think 6 months or possibly even more, unfortunately. If you are a homeowner, add in a little extra because things will break. It could be your water heater, furnace, or a leaking roof. Things have an annoying habit of failing when you least expect it to. Now, let's use an example to see as to how these numbers work out. Let's say your essential expenses covering mortgage or rent, groceries, utilities, insurance, and transportation comes to, let's say, $4,000 per month. A 3 month fund would be 12,000, while a 6 month fund would be 24,000. Now, that might seem overwhelming, but don't panic. You don't need to save it all at once. Let's talk about how to go about building such a fund. Frankly, most people don't have thousands of dollars lying around, so start small. Even savings as small as, say, $25 or $50 a week adds up over time. Something that you could do is automate it. Set up an automatic transfer to a dedicated savings account, out of sight and out of mind. Treat it like a bill. You pay rent, right? You pay your car loan. So pay yourself too in order to fund this saving. You could use windfalls. Maybe you're about to get a tax refund, or maybe there is a bonus from the work. Instead of blowing it all on a spontaneous shopping spree, throw at least a portion into your emergency fund. Lastly, think about cutting back on unnecessary spending or maybe even the small luxuries. Well, at least till you have this fund set up. If you're grabbing takeouts 3 times a week, cutting it down to two could probably save you maybe $100 easily or even more a month. So now the question becomes, okay, you have figured out a way to build this fund. So where should you keep such a fund? Well, your emergency fund should be easy to access. So it should not be invested away that is logged and not accessible. So I would recommend having a high interest savings account, could be a TFSA, and it could be a great place to park it. You definitely do not want it mixed in with your daily spending account or your regular checking account because let's be honest, that emergency could easily turn into a new TV purchase if the temptation is there. Now, let's talk about some common mistakes to avoid in an emergency. Well, firstly, relying on credit cards instead of saving. Credit cards are a very costly way to access credit, as most cards charge 20% or more in interest cost. Dipping into your funds for non-emergencies is a no-no. A flight deal is not an emergency, no matter how cheap it is. Keeping your funds in the wrong place and making it too accessible, well, that is also not good. A high interest savings account is the best. As I said before, do not mix it with your regular day-to-day bank account used to cover your ongoing expenses. And lastly, thinking, oh, I will start later, or it won't happen to me. Trust me, it happens to everyone, how much ever he or she may be earning. Most likely, the person earning more has even more expenses to cover. So start with something, even if it is just maybe $20 a month. Only once you have enough to cover for 3 to 6 months of expenses, or maybe even more, should you think about investing the excess. Trying to invest your money in stocks, ETFs, or such investments before you have your emergency fund in place or have all your non mortgage debts paid off is just foolish and short sighted. The returns from such investments is highly unlikely to cover the cost of these kinds of loans and borrowings that you take up instead. So proceed with caution. Now, another argument that some of you could come up is that, oh, I could get an EI. So why not use that as my emergency fund? Well, not because there are some drawbacks with depending on EI or employment insurance. Firstly, there are eligibility restrictions. To qualify for EI, you need to have worked for a certain number of hours in the previous year, which means if you lose your job, you may not be eligible immediately, depending on how much you worked the previous year. Claiming EI has its own processing time, leading to delays in receiving the funds when you need them urgently. This can and will push you towards higher cost loans and borrowing on credit cards, which is what you want to avoid. The benefit amount which you get from EI may not be enough to cover all your essential expenses, particularly if you have high living costs. And lastly, self-employed individuals often have limited access to EI benefits, leaving them without a reliable emergency fund or any access to money coming in when they experience a sudden income loss. So hopefully this has given you enough to think about, and maybe I have encouraged you to set up your own emergency fund and start building towards it. Shift gears to something a lot of homeowners are really stressed about right now: upcoming mortgage renewals. Now, if you bought a home or refinanced somewhere between, say, 2020 to 2022, you probably were lucky enough to lock into a very sweet mortgage rate, something maybe about 1.5 to 2.5%. But you also likely borrowed too much. Now, those days are, well, gone, way behind us. Now, as people renew in current year 2025 or maybe even in 2026, they are going to likely face higher interest rates on renewal. We are currently in the, say, 4% to 4.5% range for most mortgages, and that translates to a higher monthly payment. So, who all are likely to get impacted? Well, as I mentioned before, homeowners or people who bought homes between 2020 to 2022 and with a fixed rate mortgage. Or maybe you got a variable rate mortgage with fixed payments. Many saw their payments stay the same while their mortgage balance increased because of unpaid interest costs. Their payments will likely increase as the bank tries to put them back on their original repayment or amortization schedule. Well, there could also be a certain set of borrowers who were already stretched and had to borrow from private or B lenders and are now struggling to qualify for prime lending or to get a reduced interest cost or a payment. Either their credit is still bad, income is not sufficient, property values have not increased or maybe have even decreased in many instances. Or to make things worse, possibly a combination of all these challenges. Let's do some quick math and sort of get an idea as to how much these payments could increase. Well, if you had like a $500,000 mortgage at 2%, with a repayment period of say 25 years or 25-year amortization, your payment is probably around $2,000 and 120 a month. At 4%, that jumps to roughly 2,880 a month, which is an increase of 760 a month, or 35% from the current payment. Now, that's definitely not pocket change. Whatever might be your current mortgage outstanding, you can expect your mortgage payment to go up maybe 20 or maybe even 40%, depending on what interest rates you have enjoyed over the last couple of years. If you have unpaid interest, then that increase could be even more. Now, this is just on the mortgage front, on the mortgage payment front. Last couple of years have seen a significant increase in living expenses as well. And so this mortgage payment increase will be on top of that. Were you saving 20 to 40% of your income to start with? If not, how do you think you will be able to afford this increase? Well, what can you do as a homeowner? First of all, you need to recognize this as a challenge. Is this something that is applicable or will be applicable to you in the coming months, or maybe even in the coming year? If so, you need to plan and you need to start planning today. Generally speaking, there are things that homeowners might be able to do, but you need to determine what is it that works in your case. It could be, well, there are recent changes to the stress test rules that have made it easier to change lenders or banks on maturity or the renewal of the mortgage. So check if the renewal offer from the bank is good enough. Else prepare to move to a lender offering better terms and interest rates. But you will need sufficient income to cover the new mortgage and have adequate credit. Do note that lenders do not give credit for a side job you just started. And so, if you need more income, then start early and build a track record of consistent income. If you have accumulated more debt, it could be credit card balances, line of credit, car loans. The renewal of your mortgage is a good time to consolidate your debt and lower your payments and cost. You could also look to address things like unpaid property taxes, income tax, or any other investments that you wanted to make, but you could never get to. If having done all these things, the new payment amount is still something that you cannot accommodate, then extending the repayment period of the mortgage or the amortization period could be an option. These can generally be stretched back to 30 years or even possibly 35 years with some lenders. If qualification for a new mortgage, which is affordable, becomes challenging, you might be able to even add additional borrowers as co-applicants to help you qualify. Now, if nothing is working out, then selling might be the best option. Note that selling ahead of getting into distress is key. You will never get an adequate price or value when trying to sell in desperation. Buyers will sense that and offer less, especially in today's environment. Plus, the bank cost and fees can quickly erode any equity if you end up default. Lastly, bankruptcy or consumer proposal might not be an option if you have any equity in your home. So, speak with a professional before it becomes too late. One of the worst things you can do is ignore the problem. Late payments hurt your credit score, making it harder to qualify or even harder to qualify for refinancing later. And those could be even turn out to be more costlier. So some things that you can do are, well, set up payment reminders or auto pay your bills. Never be late. Keep credit utilization below 30%. That means do not borrow more than 30% of the credit available to you. For example, if you could borrow, say, $10,000 on your credit card, then ideally you should never borrow more than 30% of that or $3,000 in any given month. Your balance should never exceed $3,000. Well, talk to your mortgage broker or a credit professional before things get too bad. So, here is the bottom line. Preparation is key. Start building your emergency fund now, even if it is just a little at a time. And if your mortgages are for renewal soon, do not wait until the last minute. Start exploring your options today. Well, if this episode has helped you, share it with a friend who might need it. And as always, subscribe and follow for more financial tips every week. Thanks for listening. And until next time, keep getting your shit together.